You have one day. March 15th is the extension deadline for partnerships and S corporations. April 15th is coming up fast for individuals and C corporations. I'm going to guess that a lot of you are planning to file extensions. Maybe you're waiting on documents, maybe your books aren't clean yet, maybe you just need more time. Here's what most operators don't understand. An extension to file is not an extension to pay. I've seen this mistake cost cannabis operators anywhere from $8,000 to $40,000 in penalties and interest, and it's completely avoidable. I'm Daniel Sabet, CFO at GreenGrowth CPAs. Over the past year, I've reviewed tax situations for more than 200 cannabis businesses across California, New York, New Jersey, Minnesota, and Delaware. And the single most common mistake I see is that operators think filing an extension buys them 6 months to figure out what they owe. Well, it doesn't. Today, I'm breaking down exactly how extensions actually work, what you're required to pay by a deadline, even if you file an extension, and the 3 calculations you need to run in the next 48 hours to avoid penalties. Let's get into it. So first, let's clear up the confusion. When your CPA files an extension for you, here's what the extension does. It gives you 6 more months to file your tax return. That's it. If your partnership or S Corp deadline is March 15th, the extension moves your filing deadline to September 15th. If your C-Corp or individual deadline is April 15th, then the extension moves to October 15th. But here's the extension that does not do. It does not give you more time to pay what you owe. The IRS still expects you to pay your estimated tax liability by the original deadline. If you don't, you're going to get hit with 2 things: underpayment penalties and interest charges. Let me give you a real example. I work with a C corporation in Oklahoma, the cannabis manufacturer. They had $600,000 in taxable income in 2024. At the federal corporate rate of 21%, they owed $126,000 to the IRS for 2024. Now, they were supposed to make quarterly estimated payments through 2025. 4 payments, each one equal to roughly 1/4 of that $126,000, even if they're using the Safe Harbor provision. In 2025, their taxable income jumped to $800,000. That means their total federal tax for 2025 was $168,000. Now, they had already made estimated payments totaling $126,000 throughout the year. So they only needed to pay the difference by April 15, 2026 to avoid penalties. That difference was $42,000. They filed an extension, totally fine, but they still had to cut a check for $42,000 by April 15th. If they didn't, the IRS would charge them penalties on that $42,000, even though they filed the extension on time. So this is the disconnect. The extension buys you time to finalize your return. It doesn't buy you time to come up with the cash. Now let me tell you what happens when you get this wrong. I had a client come to us last year, a partnership, 2 cannabis retail locations in Northern California. They filed an extension in March of 2025, and their CPA told them they had until September to file. They thought they had until September to pay. They didn't make any estimated payments throughout the year. They figured they'd settle it up in September when they filed the return. Well, now September comes. We're brought in to clean up the books and finalize the return. Their total tax liability for 2024 was $187,000. They haven't paid a dollar of it. The IRS hit them with underpayment penalties for not making quarterly estimated payments. They got hit with interest on the full $187,000 from April 15th through September. By the time we calculate everything, their penalties and interest added up to $14,300. $14,000 they didn't have to pay, all because they misunderstood what the extension meant. And here's the worst part. They didn't have $187,000 sitting in the bank in September. They'd been operating all year thinking they had more cash than they actually did. So now they're scrambling to come up with almost $200,000 in a single month. It crushed their cash flow for Q4. They had to delay a planned expansion. They had to cut staff hours. All of this was avoidable. If they made quarterly estimated payments throughout the year, they would have owed maybe $30,000 in September. Very manageable. Instead, they owed everything plus penalties. This is why I'm so aggressive about estimated payments with every client we work with. It's not optional. It's something you have to figure out later. You have to stay on top of it. All right, now let's talk about how you're supposed to handle this. The IRS has something called the Safe Harbor provision. It's a set of rules that if you follow them, you won't get penalized for underpayment. And here's how it works. For most businesses, the Safe Harbor rule says you need to pay at least 100% of your prior year tax liability in estimated payments throughout the current year. So if you owed $100,000 in federal taxes for 2024, you need to make estimated payments totaling at least $100,000 for 2025. Those payments are due quarterly, April 15, June 15, September 15, and January 15th of the following year. If your business is higher in 2025 than it was in 2024, you'll owe more than you file. But as long as you paid in 100% of your prior year's liability, you won't get hit with underpayment penalties. Now here's where it gets tricky for cannabis businesses. Let's say you had a huge year in 2024, so you owed $300,000 in federal taxes. But in 2025, your revenue dropped. Maybe a new competitor opened up down the street, maybe you're dealing with pricing compression. Whatever the reason, you're on track to owe only $180,000 in 2025. If you make estimated payments based on 100% of your 2024 liability, you're going to overpay by $120,000. That $120,000 is sitting with the IRS instead of your bank account. That's working capital that you can't use for inventory, payroll, or expansion. This is where you need to talk to your CPA. You can make estimated payments based on 90% of your current year projected liability instead of 100% of the prior year. But you got to get the projections right. If you underpay, you're back to penalties and interest. Now let me give you another example. I work with an S corporation in New York, 2 dispensaries in Brooklyn. In 2024, they had $1.2 million in taxable income. After all the pass-through calculations, the owners owed about $450,000 in combined federal and state taxes. In 2025, they opened a 3rd location. So revenue went up, but so did expense. By mid-year, we could see their taxable income was going to land around $1.5 million. We calculated their projected tax liability for 2025 as roughly $560,000. Now, the Safe Harbor would have required them to pay $450,000 in estimated payments throughout the year based on 2024. But we knew they were going to owe $560,000. So we adjusted their estimated payments to cover 90% of the projected current year liability. That meant they paid about $504,000 in estimated payments throughout the year. When they filed in March 2026, they only owed an additional $56,000. No penalties, no interest, and they didn't tie up an extra $110,000 with the IRS all year. This is the kind of planning that saves 6 figures. All right, so you're watching this on March 15th. You have 1 day until the partnership and S-Corp deadline. Here's what you need to do right now. First, calculate what you actually owe. Pull up your 2024 tax return, look at the total tax liability, that's your baseline. Now look at your 2025 financials. If your income is similar to 2024, your tax liability is probably similar. If your income went up or down significantly, then you need to adjust. If you don't have clean financials for 2025 yet, use your 2024 liability as your estimate. It's not perfect, but it's better than guessing low. Second, add up what you've already paid. Go through your bank statements. How much did you pay in estimated taxes through 2025? You should have made 4 payments. April 2025, June 2025, September 2025, and January 2026. If you miss payments, well, that's a problem. But we'll deal with that in a minute. Add up everything you paid so far, subtract that from your estimated total liability. Whatever is left is what you owe by the deadline. Now third, pay the difference by the deadline, even if you're filing an extension. So if you owe $80,000 and you paid $60,000 in estimates, you need to send the IRS $20,000 by March 15 or April 15, depending on your entity type. You can pay online through IRS Direct Pay or EFTPS. You can pay by check. You can have your CPA submit payments when they file the extension, but it has to be paid by the deadline. If you can't pay the full amount, pay as much as you can. The penalty and interest are calculated on the unpaid balance, so every dollar you pay reduces what you owe in penalties. Now let's talk about what happens if you didn't make estimated payments throughout the year. This is where a lot of operators are right now. They didn't pay quarterly, you're looking at a massive bill due in a day. Here's what you do. 1, Pay as much as you can by that deadline. Even if it's 50% of what you owe, pay it. It reduces the penalty base. 2, file the extension on time. Don't miss the filing deadline on top of the payment issue. 3, set up a payment plan with the IRS. They have installment agreement options. You'll still pay interest, but it's better than ignoring it. And 4, for next year, get on a quarterly payment schedule immediately. This cannot happen again. I've seen operators try to catch up after missing a year of estimated payments. It's brutal. You're essentially paying 2 years of taxes in 1 year while trying to keep the business running. Don't let it get to that point. Let's talk about how to make sure you never have this problem again. Step 1, meet with your CPA at least quarterly. Not once a year in March when you're scrambling to file. Make sure to do this quarterly. In those meetings, you should be reviewing your financials, updating your tax projections, and calculating your next estimated payment. Your CPA should be telling you exactly how much to pay and when to pay it. If your CPA isn't doing this, you need a new CPA. Step 2, set aside cash every month for taxes. Don't wait until the quarterly deadline to figure out if you have the cash. Take your projected annual tax liability, divide it by 12, and transfer that amount into a separate tax savings account every single month. When the quarterly payment is due, the money is already there. For cannabis businesses, I usually recommend setting aside 25 to 30% of your net profit every month. That covers federal, state, and local taxes in most jurisdictions. It sounds like a lot, but it's money you owe anyways. You're just moving it into a separate account so you're not tempted to spend it. Step 3, understand the safe harbor rules. If your income is volatile year to year, you need to know whether you should base your estimated payments on prior year liability or current year projections. This is a conversation to have with your CPA in January, not March. Run the numbers both ways. Figure out which approach minimizes your penalties without tying up too much cash. Step 4, track your payments. Keep a simple spreadsheet. 4 rows, Q1, Q2, Q3, Q4. 2 columns, amount due and amount paid. Update it every time you make a payment. This takes 30 seconds and ensures you never miss a payment. I've had clients miss a quarterly payment simply because they forgot. They thought they paid it, but they hadn't. It cost them $6,000 in penalties. Don't let that be you. Now look, I know tax planning isn't the most exciting part of running a cannabis business. You'd rather be thinking about expansion, new product lines, or improving your customer experience. But here's the reality. Penalties and interest are a silent profit killer. $14,000 in penalties is 14,000 reasons to get this right. The operators who build sustainable, profitable businesses are the ones who treat tax planning like operational planning. It's not something you deal with once a year. It's something you manage every quarter. You have 1 day until the partnership and S-Corp deadline. You have about a month until the C-Corp and individual deadline. If you haven't calculated what you owe, do it today. If you haven't made estimated payments, pay what you can by the deadline and set up a plan to catch up. And if you're not sure what you owe or how to calculate it, reach out to your CPA today, not next week, but today. This is one of those situations where 2 days of focused work can save you 5 figures in penalties. So make it happen. If you found this helpful, drop a comment below. Let me know what state you're operating in and what's your biggest tax planning challenges right now. And if you know another operator who needs to hear this, send them this video. We're all in this together. Thank you for watching, and I'll see you on the next one. Stay sharp.